Hello, friends. Sometimes it is very difficult for you to understand the difference between the concepts of liabilities and assets, between bad credit and good credit. What is better never to take a loan for, and what can be? For example, taking a loan for a wedding celebration, for a trip to the sea, this is a bad decision. Today, many people intuitively understand this, and taking a loan for real estate is considered a good decision. Why? And what is the difference, actually? I will try to reason on this topic and formulate the main criterion, the main difference. How are these situations different? You may think, well, there is nothing bad about a credit card, it is just money that can be borrowed again until payday. Yes, indeed, a loan is just a financial market tool. A loan in itself is neither bad nor good, it is just a tool. The context and your specific situation in which this loan is taken are important. You can, for example, think, I'll take out a loan for a new car, because I need it for work, so as not to be late, to be everywhere on time. In fact, this is very similar to self-justification, an attempt to calm yourself down. Your psyche wants to find a hook, the reason why it is still worth taking out a loan for this or that product. How to understand whether this loan is toxic or a reasonable investment of money. How to understand which loan is conditionally good and which is bad. In addition to, of course, the interest rate, there are other important derivatives. And here it is important to learn to distinguish between valuable goods and services that retain their value for a long time. And vice versa, goods that quickly lose their measure of value. I want to call these assets and liabilities, but these concepts have a slightly different meaning. Robert Kiyosaki in his books and videos calls everything that does not generate income, liabilities, but there is another, nominal approach, accounting. You just need to learn to keep in mind a conditional table, where there will be two columns. In one column you write down good goods and services, conditional assets, and in the second column, bad, toxic, conditional liabilities. For example, you bought an apartment, taking out a loan for it. In the assets column you now have a property that you can theoretically sell. And in the liabilities column you now have the loan amount plus the overpayment for interest on this loan. You can visually, on a piece of paper, or mentally imagine and evaluate this. Two columns and measure the benefit of this or that column when making a decision about a purchase. Thus, if you took out a loan and something appeared in the assets column, then most likely this is not your worst decision. But if, for example, you took out a loan for a wedding or a honeymoon, then nothing appears in the assets column. Time passed, 2 weeks of vacation at sea flew by for you, and all you have left is what is written in the liabilities column. Just don't object to me now that, supposedly, after a vacation you have some memories, a boost of energy, a surge of power, etc. This is an intangible asset, but it is difficult to take into account. It's just that in this way we want to justify our impulsive purchases and wrong financial decisions. If you objectively cannot afford something, then there is no point in spending it, much less taking out a loan. We want to create the illusion of benefit, writing down some of our virtual, intangible acquisitions in the asset column. Some people, when taking out a loan, like to justify themselves and say phrases, well, I work, well, I have the right to please myself with a purchase. No, you don't have the right, if you haven't earned it yet. Or phrases, after all, we only live once, but what about impressions? Unfortunately, impressions cannot be spread on bread. If you become financially well off, then go ahead, spend on experiences, invest in trips to different countries of the world and so on. But while you are poor, just throw it out of your head. Various bloggers and motivators like to use phrases like, investing in your experiences. Or even the phrase, investing in your education. On the one hand, it sounds very reasonable and correct. You need to invest in your education, it is 100% true. But always think about what you can write in the first column of your conditional table. And what specific mechanisms of asset realization will be used. For example, if you spend a large sum of money on some courses, then ask yourself the question, how exactly can you increase your active income with the help of these courses? What will this give you? Not abstractions, but real mechanisms should be calculated. If you buy a new car on credit in the hope that this will give you the opportunity to earn more, then how exactly will this be realized? If you just drive yourself a little more comfortably, then most likely this will not give tangible benefits. This will be an ordinary loan for consumption. Justifications like, I'm investing in my quality of life, these are all from the category of narratives imposed by bloggers. If you have the opportunity, then please. But most often, people who take out loans for consumption cannot clearly formulate how this purchase will turn from a liability into an asset. If you want to be financially independent, wealthy, then forget about these false narratives. Forget the phrases, I invest money in myself, in my pleasure, in my consumption. Consumption is not an investment. Often, when assessing the well-being of a person or family, they talk about the level of consumption. That is, they measure by consumption, and not by the amount of real assets in stock. Like, he has a summer house, a car, an apartment, a dog, that means he is financially successful. No, that's wrong. If he has only one apartment in which he lives, a summer house that he uses and a car in which he drives his family, then this means that the person has no assets, but only a lot of different liabilities. Yes, all of this can theoretically be sold and converted back from liabilities into assets, but for now this person cannot be called wealthy. Any force majeure, job loss, illness or something else will instantly make such a person financially insolvent. You will have to continue to pay taxes on the apartment, the car needs to be serviced, and the lawn at the summer house needs to be mowed. All of these are liabilities, not assets. But if you start renting something out, extracting some positive cash flow, then the same product immediately turns from a liability into an asset. While your old unnecessary things gathering dust somewhere in closets and on shelves, this is a dead liability, only taking up space in the house. But if you want to sell all this on eBay, or on any other bulletin board, then this will immediately help to extract some money, some capital. Any mortgage loan, as a rule, allows you to write down at least something in the assets column. That is, the bank is reinsured and takes as collateral the goods that you purchase. As a rule, these are not the most toxic loans, but a mortgage. Because in the asset column, you can enter something real. When you have nothing to write down in the assets column, then this is a bad loan, then this is a bad purchase from the point of view of financial efficiency. If you had turned on your self-control a little, had not spent this money in such a thoughtless way, then your capital would be much higher. In the overwhelming majority of countries in the world today, capitalism, and the term itself comes from the word capital. If you do not think about the concept of capital, then you will not be able to become financially successful and wealthy. This is an obvious fact. Anyone can change their life if they replace bad habits with good ones, if they apply the accounting approach in their daily life. After all, human economic activity is not much different from the economic activity of an enterprise. Perhaps only in scale, but economic laws work the same everywhere. The role of good habits in our lives is enormous. If you feel uncomfortable in the first year of capital formation, then the second, third year, too, and only after 5 to 6 years will you feel some effect from regularly putting aside part of your income. This will not happen right away. You should be patient. Therefore, most people who expect quick results get disappointed and quit investing. It is important to integrate this process of forming a savings rate into your daily life, form a habit and even get some pleasure from the process itself. You did not spend everything, but managed to pay yourself. It is important to learn to pay yourself first, and only then everyone else, the baker from the bakery, the hairdresser, the seller from the store, and so on. Pay yourself first is the only right decision. But unfortunately, consumers prefer to pay anyone, but not themselves. These are such simple thoughts, friends. If you perceive them, feel them, then financial success and well-being will certainly await you. Subscribe to this channel, because there will be many more motivating, interesting and useful videos. Thank you for your attention. And see you soon.